Welcome to the Deep Dive. Today, we're diving into two really fundamental ideas in finance.
Yeah, sparked by the material you sent our way, which is great, by the way.
Oh, good. So we're looking at continuous contracts and also this phenomenon where futures and options prices sort of meet up with the underlying asset price near expiration, price convergence.
Exactly. And the sources you provided, they give us a really solid base for understanding these, core market mechanisms.
So the plan is to unpack what continuous contracts actually are, how they're built, why they're useful.
Right, and then tackle that price convergence thing, why derivative prices don't just fly off on their own, but tend to gravitate back towards the spot price as time runs out.
Okay, let's start with continuous contracts. Now, usually a contract has a start and an end, right?
Mm-hmm.
That's true for normal futures contracts.
Mm-hmm. They expire.
But if you want to see a long-term trend, like, I don't know, the S&P 500 over years, or oil prices through different seasons.
Looking at individual expiring contracts gets messy.
Yeah, it's fragmented. So that's where these continuous contracts come in. They're meant to give you that clearer long-term picture.
Precisely. They're synthetic tools designed to show the real trend without all the noise from contracts ending and starting.
Synthetic.
Yeah.
Meaning you can't actually trade them?
Correct. You can't place an order for a continuous contract. They're reconstructions. We mathematically stitch together the prices of real individual futures contracts, each with its own expiry date, to create one long historical price line.
Stitching them together, how does that work in practice? It sounds tricky, like linking different puzzle pieces, maybe.
That's a decent analogy. The key process is called rollover. Think about, say, a March silver futures contract that's about to expire.
Okay.
If you're holding that contract but don't want the actual silver, you need to maintain your position. So you roll over.
Which means closing the March one and opening a new one.
Exactly. You'd open a position in the next available contract, maybe the May silver future.
Right. So traders do that to stay in the market. But how does that help create a continuous historical price? Because the March price and the May price might be different. Yeah.
Absolutely. And that's the crucial second step, the retroactive adjustments. To make that historical line look smooth on a chart,
You adjust the past data.
yes. The prices of all the previous contracts in the series get adjusted by the price difference between the one that just expired and the new one you rolled into.
So if May silver is, say, 50 cents higher than March when you roll,
Then all the historical prices in our constructed continuous series, the March prices, the January prices before that, everything get bumped up by 50 cents.
okay. So you avoid those sudden jumps or gaps on the chart, even though the actual traded prices did have that step change.
Precisely. It maintains visual continuity.
The sources mention two main ways this rollover is handled, front month and volume weighted. What's the difference there?
Good question. Front month is the simpler one. It just uses the futures contract closest to expiring at any given time.
The nearest one?
Yeah. And as that one gets really close to the end, the continuous contract just switches to the next nearest one. Easy to understand, but, well, it can be a bit jumpy sometimes, sensitive to weird price moves right around expiration day for that front contract.
Okay. And the volume weighted one sounds more complex.
It is a bit. It looks at where the trading activity is. The idea is that the contract with the most trading volume is probably the most representative, the most liquid price at that moment.
Makes sense.
So the rollover timing isn't just based on the calendar date, but on when the bulk of the trading volume shifts from the expiring contract to the next one.
So it tries to capture where the market's real focus is.
Right. It can sometimes give a smoother, maybe more accurate reflection of the market price in the continuous series.
Okay, so we've got these continuous charts, this smooth history. Where are they actually used? Why should, someone listening care about these?
Oh, they're super important in a few areas. Technical analysis is a big one.
Chart watchers.
Yeah. If you're looking for long-term trend support, resistance levels, those classic chart patterns like head and shoulders or triangles, you need continuous data.
Because the individual contract expirations would break up the pattern.
Totally. Imagine trying to spot a 5-year trend in oil if your chart had a big gap every single month. It'd be impossible.
Like reading a book with pages torn out.
Exactly.
Yeah.
And then there's algorithmic trading. Algos need clean, uninterrupted history for backtesting.
To see if their strategy would have worked in the past.
Right. They can't have false buy or sell signals triggered just because of an artificial price gap caused by a contract rollover. They need that smooth, continuous series.
The sources had that NASDAQ example. March contract at 13,000, April at 13,050. The continuous chart adjusts the past data upwards by 50 points.
So you see a gradual trend, not a sudden leap. Makes analyzing the overall move much easier.
So the big pluses are that continuous data stream and, well, the simplicity of looking at one long chart instead of juggling lots of individual contracts.
Absolutely. Simplifies historical analysis, simplifies managing a long-term view. But it's important to know they're not perfect. There are potential issues.
Okay, what are the catches? What do users need to watch out for?
Well, first, the rollover adjustment itself can introduce slight distortions, like we said, front month versus volume weighted.
The method matters.
It does. Different methods will give you slightly different historical price curves, so you kind of need to know how the specific continuous contract you're looking at was built.
So useful tool, but maybe not one single true history.
Kind of. And another big thing is Contango and Backwardation.
Ah, right. When future prices are higher or lower than the spot price.
Exactly. If a market is in Contango, meaning later contracts are pricier than near ones, and you're constantly rolling from a cheaper expiring contract into a more expensive new one,
the continuous contract price will tend to drift upwards over time, even if the spot price isn't.
Precisely. It introduces a systematic upward bias just from the rollover mechanics. And the opposite happens in backwardation. You might see a downward drift.
Okay, that's a really important caveat. You're essentially paying more each time you roll in Contango.
You got it. So continuous contracts, incredibly valuable, yes. But you absolutely need to be aware of these potential biases and understand the underlying futures market dynamics for whatever you're tracking.
That NASDAQ example again, March at 13K, April at 13,050. That 50-point adjustment gets added to all the previous prices in the continuous series to make the chart look smooth. It hides the actual step up between those two specific contracts.
Perfect summary.
Okay, I think we've got a decent handle on continuous contracts. Let's switch gears now to price convergence. What exactly is that?
Price convergence, yeah, it's a tendency. The price of a derivative futures options, it tends to move closer and closer to the price of the thing it's based on, the underlying asset or spot price, as it gets nearer to expiring.
And why does that happen?
Well, the core reason really boils down to arbitrage. The market really dislikes free money, you know?
Ah, the arbitrageurs stepping in to eliminate risk-free profits.
Exactly that. It's those market forces, plus the basic logic of the contracts themselves. Let's focus on futures first.
Okay.
Theoretically, the price of a futures contract should be the spot price of the underlying plus something called the cost of carry.
Cost of carry.
Oh.
That's like interest costs, storage for commodities, insurance.
That stuff, yeah. If you're agreeing today to buy wheat in 3 months via futures, the price should reflect the current wheat price plus the cost someone incurs holding that wheat for you for 3 months.
Makes sense. You pay a bit more for future delivery.
Usually, yes. But here's the key bit. Right at the moment of expiration, that futures contract becomes a contract for immediate delivery. It's essentially the same as the spot asset.
So the prices have to match.
They must match. If they didn't, bang, instant arbitrage opportunity.
Walk me through an example. How would that arbitrage play out?
Okay, imagine it's the last few minutes before an oil futures contract expires.
Right.
Let's say the future is somehow still trading at $85 a barrel, but you can buy oil right now in the spot market for $80.
Okay, $5 difference.
An arbitrager sees this. They can instantly buy spot oil at $80 and simultaneously sell or deliver against an existing short the futures contract at $85.
Pocketing $5 a barrel, risk-free.
Exactly. Minus tiny costs, maybe? But that action buying spot, selling futures, drives the spot price up a bit and, more importantly, pushes the futures price down towards $80.
Until the gap disappears.
Until the gap disappears. These arbitrageurs are like the market's enforcers, ensuring prices align at expiry.
And does their role change depending on contango or backwardation?
Well, the effect is the same driving convergence, but the mechanics might look slightly different. In contango, where futures are expensive relative to spot.
They'd sell the futures and buy the spot.
Right, locking in that difference over time, knowing they can deliver the spot against the future later. That selling pressure helps bring the future price down towards spot as expiration nears.
And in backwardation, it's the reverse. Futures are cheap.
Yeah, they might buy the cheap futures and sell the spot, if practical, pushing the future price up towards spot. Either way, arbitrage pulls them together.
Okay, that seems clear for futures. What about options? How does an options price converge?
Options convergence, especially for European options you can only exercise at expiration, works a bit differently but still based on logic. An options price, the premium, has two parts. intrinsic value and time value.
Intrinsic value is the immediate profit if you exercised it now, right? Like if a stock's at $105 and your call strike is $100, the intrinsic value is $5.
Is correct, if it's in the money. And time value. That's the extra bit you pay for the possibility that the option could become even more profitable before it expires. It reflects volatility and the time left.
So more time means more potential, means higher time value.
Exactly. But as expiration gets closer and closer,
There's less time for things to happen.
right, less time for the underlying price to make a big move in your favor. So that time value just decays, it melts away.
Sometimes called faded decay.
That's the one. By the time you hit the expiration date, the time value is essentially zero. The options premium converges purely to its intrinsic value.
So back to that $100 strike call on a $105 stock.
Right.
A month out, it might cost $7, that's $5 intrinsic, plus $2 time value. But on expiration day, if the stock is still $105, that option will trade very, very close to just $5.
Pretty much bang on $5. The time value has evaporated. Arbitrage in options is more complex, involving hedges and stuff, but traders definitely position themselves to capture that decaying time value and anticipate the convergence to intrinsic value.
The sources also mention psychological factors and market dynamics.
Yeah, those play a role too. As expiry gets really close, lots of traders just want out. They close positions to avoid dealing with exercise or delivery.
So more activity focused on just aligning with the underlying.
Kind of. That activity can make the derivative price more sensitive to the underlying's moves. Also, sometimes liquidity dries up in the expiring contract, which can also make its price track the underlying more tightly, almost by necessity.
It's like the derivative is on a shorter and shorter leash to the underlying as its life ends.
That's a really good way to put it. But we should probably mention, it's not always a perfect razor-sharp convergence down to the last cent.
Oh, what can stop it being perfect?
Well, things like high transaction costs. If the potential arbitrage profit is smaller than the cost of doing the trades, maybe a tiny gap persists.
Okay.
Or very illiquid markets. If you can't easily buy or sell the underlying asset quickly, the arbitrage machine can't work perfectly.
Right, you can't exploit the difference if you can't trade both sides.
Exactly. And, really extreme events, market shocks. Sometimes things get temporarily out of whack, even near expiration. But generally, the pull towards convergence is incredibly strong.
The gold futures example in the sources seem pretty straightforward.
Yeah.
Spot gold $1,800, near future $1,820.
Yeah. Arbitrageurs buy spot at $1,800, sell futures at $1,820. That selling pressure on futures pushes its price down towards $1,800 by the time it expires. It just has to happen.
It all comes back to that no free lunch idea.
Pretty much sums it up. So, just to recap our deep dive today, continuous contracts, they give us that smoothed out historical view by cleverly managing futures rollovers. Price convergence, this fundamental force pulling derivative prices towards their underlying assets price as expiration hits.
And crucially, that convergence isn't magic. It's the direct result of market participants, especially arbitrageurs, stamping out those risk-free profit opportunities, which, helps make the market more efficient overall.
Absolutely. Which leads to maybe a final thought for our listeners. Thinking about how these mechanisms work, building long-term views with continuous contracts, understanding the power of convergence, how might that shape your perspective? Not just on market function, but maybe on potential strategies or risks. Something to consider while always keeping in mind the real-world complexities involved.